Imagine you wake up tomorrow and the dollar suddenly becomes much more expensive. You live thousands of miles from the United States. You don't earn dollars. You don't have a U.S. bank account. So why should you care? Because the price of fuel could change. The cost of imported electronics could change. A company's debt payment could suddenly become harder to afford. Even the price of goods sitting on a supermarket shelf could eventually move. And here's the strange part. You don't have to own a single dollar for the dollar to affect you. So how did one country's currency become so deeply connected to the rest of the world? The dollar doesn't control the global economy because America tells everyone what to do. It controls the system because so much of the system is already built around it.
When people say the dollar, they're often talking about several different things. First, there's the physical dollar, the notes and coins you can hold. Second, there's the bank dollar, balances moving through financial institutions. Third, there's the trade dollar, the currency used to price and settle enormous amounts of international commerce. And fourth, there's the financial dollar, the currency used in bonds, loans, reserves, and global investment. Think of the dollar like electricity. You don't need to personally own the power grid to depend on it. The same idea applies here. When a company in one country buys something from another country, the transaction isn't always settled in either company's home currency. The dollar can become the bridge. Imagine a manufacturer needs a shipment of oil. The oil producer may price that commodity in dollars. The manufacturer may earn revenue in another currency, so the company needs access to dollars. That creates demand for the currency far beyond America's borders. And this is where the dollar becomes much more than a piece of paper. It's a common financial language.
Now, imagine the dollar strengthens by 10% against another currency. For an American tourist, foreign goods may suddenly look cheaper. But for a company outside America that borrowed $100 million, the story can be very different. Its debt is still exactly $100 million. But if its local currency falls against the dollar, paying that debt becomes more expensive in local currency terms. Nothing about the original loan changed. The exchange rate did. That is the hidden cost. A currency move thousands of miles away can change the economics of a business that never sells a single product in America. Now, follow one ordinary product. A smartphone might contain minerals from one country, components from another, manufacturing somewhere else, and software developed in yet another market. Money moves through suppliers. Suppliers pay workers. Companies borrow money. Banks settle transactions. Investors finance businesses. And somewhere along this chain, the dollar can appear as the pricing currency, settlement currency, investment currency, or debt currency. This creates a powerful network effect. The more businesses use the dollar, the more useful the dollar becomes. The more useful it becomes, the more businesses have an incentive to keep using it. That's a feedback loop, and feedback loops are difficult to break.
Here's the part most people miss. The dollar's biggest advantage isn't simply that Americans use it, it's that the rest of the world uses it too. Central banks hold dollar reserves. Global investors buy dollar-denominated assets. Companies issue dollar debt. International commodities are frequently priced in dollars. And financial institutions need dollar liquidity. So the United States doesn't just have a currency. It sits at the center of a massive financial network. And when that network moves, the rest of the world can feel the movement. The currency became infrastructure. But being at the center of the system doesn't mean the system is risk-free. A stronger dollar can create pressure on borrowers with dollar-denominated debt. A weaker dollar can change import costs. Interest rate changes in the United States can influence global borrowing conditions. And when investors suddenly want safer dollar assets, money can move across borders very quickly. This creates what we can call the dollar gravity effect. When global financial uncertainty rises, demand for dollar assets can pull capital toward the United States, and that movement can create pressure elsewhere. The system is connected.
So what determines how powerful the dollar is? One of the biggest variables is trust. Trust in U.S. institutions, trust in financial markets, trust that dollar-denominated contracts will remain enforceable, trust that the currency will remain widely usable, and trust creates liquidity. When millions of participants already accept the same currency, switching to another currency isn't simply a matter of printing new banknotes. You would have to rebuild the network around it. Banks, contracts, markets, reserves, payment systems, and habits. That is an enormous switching cost.
Imagine a company outside the United States earns 1 billion units of its local currency every year. It has a $100 million denominated loan.
At one exchange rate, that loan might represent 300 million units of local currency. Now the local currency weakens by 20% against the dollar. The company still owes exactly $100 million, but the local currency burden has jumped dramatically. Its revenue didn't necessarily change. Its factory didn't necessarily change. Its employees didn't necessarily change. The currency changed. And suddenly, the economics of the entire business changed with it. That is why the dollar matters even when you never touch one. Because the dollar isn't simply America's money. The US dollar isn't just America's currency. It is the infrastructure connecting a huge part of the global financial system.